The most dangerous portfolio in America is not the one that loses money in a crash. It is the one that only works when the weather is perfect. That is where I want to begin, because most people do not build portfolios. They build fair weather houses. They put their life savings into a structure that looks polished, diversified, respectable, and professionally approved right up until the first real storm hits. Then inflation arrives, or a currency weakens, or a market breaks, or an opportunity appears when everyone else is illiquid, or interest payments come in looking safe while purchasing power quietly dies behind the scenes. And suddenly the beautiful house reveals what it really was, a paper shelter. Not a fortress. I have spent my life thinking about capital as if it were architecture. If you build a bridge, you do not ask only what it looks like on sunny days. You ask what happens when the river rises, when the wind shifts, when rust appears, when the load gets heavier than the designer expected. A portfolio should be built the same way. It should not merely survive optimism. It should endure pressure. That is why I have so little respect for lazy conventional asset allocation. Conventional allocation flatters the industry because it is easy to explain, easy to package, and easy to defend by pointing to history. But your future does not care whether your portfolio looked respectable to a committee. Your future cares whether your capital preserved purchasing power, maintained optionality, and gave you the strength to stay calm when the crowd became frightened. That is why I want to talk about a fortress, not a pile of tickers, not a clever trade, not a manager's favorite talking points. A fortress. The source document behind this story frames the whole issue in a very useful way. It says most people think building a good stock market portfolio requires endless expertise, stock picking, and constant adjustment, but then argues that a powerful structure can be built with only 4 investments, 50% in the S&P 500, 10% in international stocks, 20% in gold, and 20% in an opportunity bucket. It rejects the classic 60-40th framework because it sees bonds, especially treasuries, as weak protection in an inflationary world, and it wants a portfolio that can grow while also defending against currency debasement and giving room for conviction plays. That is the core line I am preserving, but I want to make it much stronger than a list, because lists are how people memorize ideas without understanding structure. And structure is everything. A fortress has 4 critical elements: a central wall, an outer ring, a fireproof vault, and a mobile reserve. That is what this portfolio is really trying to build. The central wall is the S&P 500. The outer ring is international exposure. The fireproof vault is gold. The mobile reserve is the opportunity bucket. That is the frame. And if you understand the frame, you stop asking childish questions like which asset will do best next year, and start asking adult questions like what kind of structure lets me survive multiple futures without losing my mind. That is the first truth. A good portfolio is not an opinion about one outcome. It is a structure built to endure several. Let us start with the central wall. The source puts 50% into the S&P 500 through a low-cost index fund, or ETF, and this is the part most sensible people will immediately recognize. Good, they should recognize it. The S&P 500 is the structural core because it solves one of the biggest traps in investing, the ego trap of trying to outguess the market every week. The source is right to say you do not need to pick the winners one by one when the index itself is already a mechanism for holding the strongest large companies while weak or shrinking members are eventually replaced. That is not magic. That is institutional Darwinism. This matters more than people think. A lot of investors still behave as though intelligence in markets means making a long series of precise forecasts. It usually does not. Intelligence in markets often means surrendering the parts of the game where your ego is weakest and your odds are worst. Stock picking feels intelligent because it creates the emotional satisfaction of control. But for most people, the S&P 500 is superior precisely because it removes the need to be a prophet and allows you to become an owner. That is a very different identity, not trader owner, when you own the broad productive core of corporate America. You are not betting on one management team, one product cycle, one regulation, one charismatic founder, or one story you fell in love with after reading too many online threads. You are buying participation in the aggregate muscle of a large system. Some companies weaken, some disappear, some surge, The index keeps evolving. The wall repairs itself over time. That is what a central wall should do. A central wall is not meant to be exciting. It is meant to hold. The public keeps forgetting this because modern financial culture is built around stimulation, not strength. People want portfolios that tell flattering stories about themselves. I understood AI early. I knew the energy cycle. I bought the turnaround. I saw the disruption coming. Fine, have your stories, but stories are not walls. Stories are banners. A fortress with weak walls and beautiful banners still falls. That is why the SP Core matters so much. It is humble. It does not flatter you. It does not let you pretend you are the smartest person in the room. It simply lets you own a productive machine that has historically adapted better than the pride of individual investors. The sources also write about why this kind of broad core captures long-term growth without forcing you to become a full-time operator of your own anxiety. A person staring at 5 or 10 individual positions every day is not just managing investments. He is managing self-doubt, greed, regret, overconfidence, and the constant temptation to do something merely because the screen is moving. An index fund strips much of that poison away. The wall stands whether your mood is elegant or not. That is the second truth. The best core is often the one that makes your ego least important. Now let us step beyond the central wall and look at the outer ring. International stocks, the source assigns 10% here, and that number is less important than the principal. Most American investors have a strange blind spot. They imagine that because the United States has been such a dominant engine of wealth creation, domestic concentration somehow stops being concentration. If the country is large enough, that is nonsense. A single country is still one jurisdiction, one policy regime, one political system, one currency zone, one broad economic cycle, one basket of assumptions. The source puts it plainly, holding 100% in one country, even the United States, is still a risk. Exactly. Different countries move through different cycles. Developed markets and emerging markets do not react identically to the same pressures. Currencies move differently. Policy errors are distributed differently. Growth paths are different. By adding both developed and emerging international exposure through a broad fund, the portfolio creates regional, sector, and currency diversification without requiring the investor to become a geopolitical forecaster. This is why I call international exposure the outer ring of the fortress. An outer ring does not replace the central wall. It extends the defensive perimeter. It prevents one national narrative from becoming your whole financial climate. This is psychologically important too. Investors who become too domestically concentrated often mistake patriotism, familiarity, and recency for prudence. They know the logos, they know the news flow, they know the stories. That familiarity feels like safety. It is often just a more socially acceptable form of concentration. The outer ring interrupts that. It says, your future does not need to be wagered entirely on one map. That is adult thinking, not anti-American, anti-fragile. There is another reason international exposure matters, and it has less to do with return chasing than people think. The source explicitly says this 10% is not about maximizing returns so much as reducing risk over time. Good. That is the correct emphasis. A fortress is not built by asking which wall segment will have the highest short-term charisma. It is built by asking what broadens the structure and reduces single-point failure. International exposure does that. It creates more possible paths by which your capital can still behave reasonably if one domestic regime becomes stressed. That is the third truth. Diversification is not a way to look clever. It is a way to remain functional when one story stops being kind. Now we come to the part of the source that makes the structure controversial, gold 20%. The source calls gold your insurance policy and places it where traditional portfolio advice often puts fixed income. This is where most standard practitioners start twitching because the orthodoxy says the safe side of the portfolio should be built from bonds, especially treasuries, while gold is treated as optional, eccentric, or maybe a tiny side holding if you must have it. The source rejects that. It argues that fixed income can, quietly lose purchasing power when inflation exceeds the yield, and that nominal safety is not the same thing as real protection. Again, that is the heart of the disagreement, and it is a serious disagreement, because what is safe if the dollar's returning to you buy less life? The source uses a simple and very effective example. A gold coin does not multiply into 2 coins by sitting there. But if the currency is debased over time, more weakened dollars are required to buy the same ounce. That is the key. Gold is not in the fortress because it is expected to behave like a productive business. It is in the fortress because it behaves differently from productive businesses and differently from fixed claims denominated in paper promises. It is a fireproof vault. A fireproof vault is not the main hall of the castle. It is what you are grateful exists when the flames touch the rest of the structure. That is how I want you to think about gold, not as a religion, not as a growth engine, not as a macho anti-system badge, as an insurance chamber against the failure modes of paper. The modern investor is often too clever to admit how important this is. He has spreadsheets, he has real return assumptions, he has laddering models, he has inflation charts, he has central bank speeches. Wonderful. And still, a basic truth remains. Anything that depends on the issuer's willingness or ability to preserve purchasing power is not invulnerable. Gold sits outside that promise structure in a way that makes it politically inconvenient for the orthodox and psychologically comforting for the prepared. The source is also right to say that most industry portfolios ignore gold because it does not fit the narrative of Wall Street profits. That line is blunt, but there is truth in it. The financial system likes assets that are easy to package, fee, trade, and benchmark. Gold sits more awkwardly inside those incentives. It does not flatter the usual production line of portfolio salesmanship. That does not mean every professional hates it. It does mean the standard template is not designed around deep respect for real purchasing power defense. This is the fourth truth. What protects you best in certain scenarios is not always what the system most wants to sell you. Now let us move to the most misunderstood part of the fortress. The mobile reserve, the opportunity bucket, the source gives it 20%. And this is where people who crave permission either become liberated or dangerous. The document explicitly says this bucket can include silver, copper, uranium, oil and energy, tech stocks, REITs, Bitcoin, crypto, cash, fixed income, other than treasuries or combinations of these. But then it says something very important. This is not a license to gamble wildly. It is a controlled area for calculated risk, personal conviction, and flexibility, with the key discipline being containment. You can take risks without risking the fortress itself. That containment principle is everything, because this bucket is not there to make you feel alive. It is there to keep your curiosity from burning down the rest of the structure. Every serious investor eventually develops views, themes, convictions, or tactical interests that fall outside the quiet discipline of broad indexing. Fine. Humans are not robots. The mistake is not having a view. The mistake is letting every view become a full-scale invasion of the core allocation. The opportunity bucket solves that by creating a sanctioned zone for tactical expression. You can be interested in uranium, digital assets, energy scarcity, precious metals, miners, special situations, real estate, or even cash as dry powder, without handing those ideas the right to endanger the entire fortress. That is why I call it the mobile reserve. In a real fortress, a mobile reserve is what you use when the terrain changes, when a weak point appears, when opportunity opens, when the enemy overextends, or when a new threat requires movement instead of static defense. This 20% does that. It prevents rigidity, it prevents the structure from becoming too doctrinaire to adapt, and it gives the investor a controlled place to think that matters psychologically in a way most allocators understate. If a portfolio is too rigid, many people will eventually rebel against it in the most destructive way possible. They will blow up the core because they feel trapped by the core. A contained opportunity zone is not only financially useful, it is behaviorally intelligent. It gives the investor enough room for agency and curiosity without letting agency become self-destruction. That is the fifth truth. A structure that ignores human behavior is not actually strong. Now let us step back and look at the four-part fortress as a whole. 50% SP 500, 10% international stocks, 20% gold, 20% opportunity bucket. The source says this structure gives growth through stocks, protection through gold, diversification through international exposure and commodities, and flexibility through the opportunity bucket. That is the visible description. The deeper one is more useful. The fortress lets you participate in prosperity without being entirely exposed to one form of prosperity. It lets you respect inflation without becoming an apocalypse fetishist. It lets you personalize part of the portfolio without letting personalization metastasize into ego-driven speculation. It lets you stay invested because every part of the structure has a mission. That last line may be the most important in the entire source. It helps you stay invested. People love to pretend that the hard part of investing is finding the best asset mix. The hard part is living through your own emotions long enough for the mix to matter. A theoretically elegant portfolio that you abandon in panic is inferior to a simpler structure you can actually hold through storms. The source says markets are designed to go up over time because of inflation, money printing, intervention, and the basic mechanics of the system. And whether one agrees with the exact framing or not, the deeper behavioral point is right. The investor must be able to remain in the arena long enough to benefit from the long arc. This is the sixth truth. The best portfolio is not the one that looks smartest in theory. It is the one that keeps you from becoming stupid under pressure. That is why the 60-40th discussion matters so much. The source begins by rejecting the classic 60% stocks. 40% bond structure. It argues that the safe bond side is not truly risk-free because fixed income can lose purchasing power during inflation, especially when the yield is low and taxes further reduce the real result. This is the essential critique. Traditional safety is often nominal safety, not real safety. A bond can return dollars exactly as promised while still leaving you poorer in practical terms. That does not mean all bonds are worthless in every context. It does mean the label safe must be interrogated. I am less interested in ideological fights between gold people and bond people than I am in one honest question. What function do you need the safe side of the portfolio to perform? If you need price ballast, that is one issue. If you need current income, that is another. If you need inflation defense, that is different. If you need optionality, that is something else again. The weakness of the generic 60 divided by 40 template is that it often assumes one kind of protection is sufficient for everyone, when in reality different threats require different defensive materials. That is why the fortress framing is better. It forces you to think in missions, not labels, wall, outer ring, vault, reserve. Each piece earns its place by function. This is where modern investors usually fail. They do not define the mission of each dollar. They define only the broad aesthetic of the portfolio: balanced, aggressive, moderate, growth-oriented. These are useless words if they do not answer what happens when inflation surprises. When one country weakens, when a crash creates bargains, when your convictions change, when liquidity matters, or when your own behavior becomes the biggest threat inside the walls. The fortress answers those questions more honestly. Now, let us talk about behavior because the source correctly says behavior is the hardest part. People panic during downturns. They try to time markets, they withdraw money too early, or they never start because they think investing is too complicated. Exactly. Complexity is often an alibi. People tell themselves they are being prudent by waiting until they understand more. In reality, they are postponing ownership because ambiguity feels uncomfortable. The four-part fortress solves that by reducing decision count without reducing structural thoughtfulness. That is a huge advantage. Decision fatigue destroys portfolios. Constant tinkering destroys portfolios. Daily screen watching destroys portfolios. The temptation to interpret every market wiggle as a personal summons destroys portfolios. A strong structure reduces all of that. You know what the wall is for. You know what the outer ring is for. You know what the vault is for. You know what the reserve is for. When you know the function, you stop demanding that every part of the fortress win every quarter. That is another adult difference. People with weak structures need constant reassurance because they do not know what each piece is doing. People with strong structures can watch one section underperform without losing faith in the entire design. The wall does not need to be gold. The vault does not need to be a growth engine. The reserve does not need to act like the wall. That clarity is calming and calm is profitable. This is the seventh truth. If you do not understand the job of each asset, you will fire good workers for doing the wrong job well. Now, I want to say something that the source hints at, but that deserves to be made more severe. The purpose of a simple portfolio is not to make you simplistic. It is to free your mind for the things that matter more than constant reaction. A person with a coherent fortress can spend more of his life earning, reading, thinking, creating, negotiating, building a business, raising children, strengthening relationships, and preserving health instead of living in the glowing anxiety chamber of financial overactivity over complication looks sophisticated. It often just steals life. The public regularly underprices this cost. They think portfolio management ends with returns. It also consumes attention, and attention is life's most limited capital. A structure that is simple enough to hold and robust enough to endure gives you your mind back. That is not trivial. That is one of the highest returns any sound design can produce. Now, let me address the most likely objection. What if one part of the fortress lags for years? Of course it will. A real fortress is not built from four identical walls because the world is not threatened by one identical danger. There will be periods when gold looks useless, when international stocks disappoint, when the S&P 500 carries everything, when the opportunity bucket feels brilliant, and then later when the opportunity bucket looks like foolishness. Good, that is not failure. That is specialization. Each component exists because the future will not be uniform. The problem with most investors is not that parts of their portfolio lag. It is that they cannot tolerate lag without interpreting it as a verdict on their intelligence. That is ego again. A fortress is anti-ego architecture. It assumes uncertainty. It respects multiple futures. It leaves room for weather. That is why it can survive. The source concludes with a very important sentence. You do not need complexity to build wealth. Just a simple structure, discipline, and time. That is right. But I would strengthen it this way. You do not need a portfolio that wins the argument online. You need one that survives your behavior, survives inflation, survives domestic concentration, survives your need for a controlled outlet for conviction, and survives enough future scenarios that you never become dependent on a single cheerful story. That is the eighth truth. The point of a fortress is not elegance. It is survivable strength. So here is the final choice. You can keep living in the fair-weather house the system loves to sell you, a structure that looks respectable because it follows convention, sounds mature because it uses the approved language of safe assets, and feels civilized because it asks you to ignore uncomfortable threats until they become expensive. Or you can build something stronger. A central wall that grows with productive enterprise, an outer ring that reduces dependence on one country's mood, a fireproof vault that respects the reality of currency debasement, a mobile reserve that captures flexibility, conviction, and opportunity without letting your curiosity burn down the fortress. That is not a tip. That is architecture. And architecture is what decides whether your money merely exists on paper or actually stands guard over your future when the weather turns violent. Because the storm will come, inflation will return in one form or another, markets will panic again, currencies will weaken again, opportunities will appear only for the liquid and the calm. And when that day comes, the only thing that will matter is whether you built a structure meant for sunshine or one built to survive the siege. That is what a real portfolio is for, not admiration, endurance.